Welcome back to another Market Insight, joined as always by Aaron, repeat guest here. Dan, who's our COO.
It's good to be back.
We're going to talk a little bit about AI. He's been doing some of his own vibe coding that actually looks incredible. And Brian, CFO, who pays for it, so we'll know, are we going to be canceling some of these subscriptions to go with some of Dan's products. But first, got to hit the major headlines, the Iran war, and really where it goes to us is our base case, what we've seen multiple times, be the Trump playbook. It's worked this way through tariffs, through his deals, through Greenland, Venezuela, and now, we'll follow the same trend. It is, at least so far, built into 3 phases. The first phase is maybe the least important. I'll go through this pretty quickly, but all of the conflicts, they start this way. There's some sort of positioning. You don't know when it's going to happen, but you can see it starting. This started to happen, and then gave his red line. Now, we were talking about it. You were predicting that the strikes were going to come on that Saturday for that reason. Is he gave the red line, and there was no deal to be made.
And this is when everybody panics, right?
It's when you start moving into the panic, and that's what gets called risk premium across asset classes. It's just selling off everything. And this time, actually, you never know if it's going to be bonds could get a bid. We were talking about this as it was happening. Are we going to see bonds move up? But oil price shock was so strong initially that it became the inflation scare where bonds could not get bid. And gold actually got sold off the most, more than stocks, which is pretty interesting. And you move to Trump saying this is the forever conflict. He tweeted that multiple times.
Maximum pressure.
Maximum pressure. Don't let your enemy know that you're ready to de-escalate at all. The market started to get a little finicky, and he started doing both. Hey, we can fight forever, but also this is an excursion, and maybe we're done in 2 to 3 weeks from now. And that is really, we're on week 3. I know it sounds a little crazy to think this could be done in 2 to 3 weeks, but that has really become our base case, that it's not a prolonged conflict. He wants to make you think it is, because that's his steps before de-escalation.
I think you're onto something there. I think with oil prices starting to come back down, you're seeing the market begin to price that in. But I do think there is panic that this is a prolonged conflict. Iran is a much bigger, much nastier enemy than Afghanistan and Iraq. And I don't think we're positioned well if this is a prolonged conflict. What would you say, Aaron?
Oh yeah, I would think that you're assuming that Trump has all the cards here. You have a regime that is part of a country that's thousands of years old, that has a much longer time horizon than the secular West, and really has nothing to lose. If anything, I would say that the regime of Iran is in a stronger position than it was prior to this. And what happens if they continue to cause havoc in the Strait, despite Trump probably in the next 2 to 3 weeks at some point declaring victory, and they're saying, we've just started. So I think you're assuming that Trump is the person that can pull this strategy off, and the fact that we have the strategy up here and it's well known starts to create a new game.
Mm-hmm.
The thing I think about is, what does a clear victory even look like here? I mean, how do you get to a point where you say, okay, now we won? Like, what does a win look like? I've read from all these different people, and it's still very unclear to me what a clear win looks like in this area.
Well, you can play the whack-a-mole game for, to your point, a year, longer if you want to, but that's never been part of what Trump's philosophy has been. Now, I think just pulling out of the conflict I don't think you're going to have extreme problems in the Strait, which is the main issue, mm-hmm. right? Could that happen? Of course. That's what markets are getting, on edge about. But that's when you have to see, is there a deal that can be made of saying we pull out, you get, some more calm in the Strait, or,
And I would say the deal with who? The family that has probably 80% of their family gone. Like that's the person that you're going to negotiate with. So I just think it's a lot more complex, and it's something where the toothpaste can't be put back in the tube. Yeah. It's definitely going to change. Hopefully 2 to 3 weeks we're done talking about it. But this has been something that's been going on prior to the Shah, going all the way back to whenever the United Kingdom had Iran as part of its empire. So this is another chapter, and we just don't know how it plays out.
And it's really interesting when you talk to clients, because you have the hardcore Trump base, and then you have the people who despise Trump. And the people that despise Trump are looking at what happened at the NATO summit with Greenland, then Venezuela and the cartel leader, and now this, and they're like, we're exhausted by this. This is chaos and embarrassment at the national level. Then you have the Trump base that is fired up. They're like, we are finally exerting our power. The U.S. military is having extreme success, and some of these missions are, we've never had better missions, and trust Trump to get us through it. And it's so interesting who you talk to, what perspective you have that comes out of it. But Chris,
the political will is weighing on some of that, right? If this is still going on when we record these monthly next month, there's just no political will to keep this going.
I think so. You have midterms coming up. You have the big summit with China that got delayed. And I think Trump signaled he wants this conflict to be done before he goes to China and has that summit.
And I think he campaigned on America first. This does not align with America first for a lot of the people that were his strong base. He's being hit from both sides. It's not just people that are of the political persuasion of the left. It's also people that are on the right.
I think you're spot on there. You see the differences now emerge between America first, MAGA, and the neocons. All the rifts on the right are, this is exposing. So you had last night, Kent resigned, right? He's the leader of counterterrorism. He resigned and said, we don't have an interest here. This was just an aggressive act. You have J.D. Vance basically hiding in the background right now saying, I don't want to touch this, because he has his pulse on 2028. And there's primaries happening now, there's midterms coming up, and this is not popular.
Right.
And I think that there's going to be a trickle-down effect that's going to play years to come, because cooperation internationally going forward when these things happen, it's going to be very interesting. We're seeing that now. We thought we were going to have allies helping, and there hasn't been. Mm-hmm. So it's going to be very interesting what takes place in the next couple of years when this will happen again. Mm-hmm. This isn't unique.
Well, it's funny, and you have, out of the administration, you have good cop, bad cop. So Trump says, we don't need you, NATO. We don't need your help in the Strait. Probably today you're going to have Scott Bessent come out and say, America first doesn't mean America alone. And you're going to have that dual confusing messaging, which is just more uncertainty. But, Chris, the piece I'd like to bring it back to is markets. So geopolitical conflict, you get these dips in markets.
There's no sign of de-escalation yet, so let's just close out the playbook. Right, we hit Carg Island last Friday after markets closed.
It's like garage cars. The G is a J. I don't know. Why don't we spell it with a J whenever we're translating, because it's in Arabic. But we did hit it for sure.
Yeah, and that's not good for oil prices. We hit. I shouldn't say we. Don't know who hit. The headline just hit a couple hours ago. Whether it was Israel or us, was hitting some oil infrastructure as well. Or
in Carg Island?
No, it was the LNG ports.
But I think what's interesting is the U.S. is a net exporter of oil and gas now. And you've had international stocks outperforming the U.S., especially last year. And they're going to feel the brunt of what happens with energy a lot more than we will. So my question is, does this ironically lead to capital flowing back to U.S. markets, or do we see the trend of it international continue to outperform?
The way we measure trends tends to be more like a 2 to 3 month, and so this would just be a shock. But what you said has moved at least the signals a little bit. It hasn't said that the international is selling off to a point where the trend's over, which is common for a shock, but it's definitely pushed money back to U.S., out of gold into U.S. tech stocks, actually. So it wasn't really a total risk-off move. Sometimes you'd expect to see gold go up and tech stocks go down. It's actually the exact opposite of that. Well, just to wrap the market impact, right now we're really just trading off of oil. Oil shocks are up, market's down. For the most part, that's what we're seeing. I like the example of actually going back to 2022. Complicated looking chart, but this is the initial start of Russia-Ukraine. Oil prices are in blue. Big spikes over 120. Markets go down 20%. Not predicting that at all here. And oil starts to settle back in. I drew a green line there. About 85 is where we settled in, and that's where markets bottomed at the end of the year. I'm also not saying we're going on a 60% rally like we did the next few years, but what happened to oil is it steadily, and it was a little volatile, came down over the next 3-4 years. That's what I think is going to happen again. We have oil spike, we're going to settle in a little bit higher, maybe even in that 80s range, and spend the next few years coming down. If you can remember all the way back to 2 months ago, the narrative was we have so much oil. There's an oil glut. The world is awash with oil. Oil prices were under $60 in the high 50s. You can see that at the chart at the very end, right before we of course spiked. So that's what I think's really the base case. That's what the market thinks. Now the futures price of oil is not a perfect predictor. So there's not a great way to just say this is exactly what's going to happen. But this is the expectation from the futures, which is we're in the 95 to 100. Once we start seeing over 100 on those spikes, market does get a little finicky. But over the next 2, 3, 4 months, settling back down in the 80s before we go back in the 70s, I think is really the base case of expecting what we should expect here.
I haven't seen the derivatives equation since the CFA.
I put that in there for one reason, which is because if you're a real big futures nerd, you would say this is not a perfect predictor. It's because of some funkiness in the equation.
No, come on.
I didn't want to get called out for that.
Markets act just like physics, right?
Another good example, just to point to another time period, 2011 to 2013, it was a great recovery from obviously the GFC, and S&P annualized almost 14%. Oil prices were in the high 90s. Strong demand then. To your point, we were producing about half as much as we produce now in the U.S., and oil prices were much higher, and our market was able to put up with that for a few years. Now the shock will be worse than that if we're still 95 6 months from now. I think the stocks will be lower, but that's not in our forecast at all.
So would you say the inflation will be transitory this time, Chris?
Yes, but it's going to be a headwind for 2 to 3 months. 2 quarters, multiple months. This is going to be a shock that works its way through the system. You're seeing constant headlines. It's not just oil, fertilizer, it's food. It's not going to be easy. The Fed has a tough job with what they're going to do to this, but actually, if you hear them, potentially, it's actually an easy job. You do nothing. They're not going to cut rates anytime soon.
I think we've been talking a lot about markets and the things that can impact them in a negative way, which the war certainly can. But what about the things that are really adding production capacity? And we see AI really taking off here in a lot of ways. There's a lot of fear that they're going to take my jobs. And I think this time is the same as every other time. We'll just continue to increase production. And I just think that is, despite what's happening in Iran, despite all of the what-ifs that we can play out and all this different scenarios, and who knows what it's going to be like, there's still a lot of optimism within the broader economy. And I think that is this AI revolution, where a lot of the tasks that people do are likely, and that you associate with your work, are likely to diminish as it becomes far more purposeful. And I find this one to be very, very fascinating because we've seen examples going all the way to the Luddites whenever they're burning the looms because they're no longer able to weave fabric, and what happens further down. So as somebody that's always enjoyed history, especially economic history, I feel like I'm living it.
I'm kind of at the center of this for the firm, and Aaron just nailed me this week. He goes, so what you're saying, Dan, is this time is different? And I was like, oh my gosh, I'm too close to it. I need to zoom out. This time is not different. The labor will be repurposed in much bigger and better ways than we ever imagined. And it's tempting to be brought into the pessimism and the doom and gloom on AI. You always sound smart and cool if you're taking that take. It's like the people that are always bearish. But I truly believe this is going to be an age of abundance, and a lot of productivity is going to be unlocked our work is going to be much more fun. The drudgery is going to get stripped out of it. And just some of the use cases as a firm, I think, are unbelievable. But before we get into that, I'd love to hear your take just broadly. How is software doing this year?
I was just thinking, like, it's so much easier it would have been so much easier for me to say oil's going to 150 and stocks get hit than say oil's going to be at 70 by the end of the year and we're going to be okay. But to your point on software, public software is not doing well. And it's taking out a lot of, we haven't been a big allocator to public software, but it's taking out other places with it. And we do have exposure to names that got pulled down because of it, like things like Schwab. We spent a lot of time talking about last month, but no, and you can start talking about private credit from this, which is really the same thing. There's fear that these are going to be completely automated away.
Mm-hmm. So where is software year to date? Can you frame it a little bit for us? Has it bottomed yet? Is it still trying to find the bottom?
It's trying to find the bottom, and a lot of it actually has bottomed, but that is very short term. We're talking about 2-3 weeks over the course of this. This is not.
Is it still in bear market territory?
Oh yeah, this is going to be a multi-year story though. This isn't something we're settling in this quarter.
Go ahead, Brian.
Well, I think this topic there's so many headlines going on with AI, and the big fear is obviously people losing their job, which is really interesting because I'm still involved in a lot of family relationships, and they're usually the first thing people ask when you meet a new person, other than in St. Louis, which is the first thing is where'd you go to high school, which that's not a common first question people ask when you travel across the country, but is what do you do? That's usually the first thing that people ask. And if you think about that further, is that there is a meaning and value to the work that someone does. So when that work that someone does is in jeopardy, regardless of 10 years, we're in a better place because of this technology. There's a human part to it. Mm-hmm. And you see people, it's easy for us to sit here and say like, oh, this is a good thing. And I do think this is a good thing. Well, we're the shareholders of Gatewood. So
yeah,
we're
I think
unique to that situation.
I think the K-shaped economy, this is just gasoline on that. Like you talk to people that are on the cutting edge of this, they're so excited, they're going to be the upper K. You talk to people that are afraid of it and aren't even using the tools and they're resisting it, they're going to be the bottom part of the K. And there's going to be a real human toll going through this. Like you saw Block laid off, 40% of their labor and rallied how much?
20%.
20%. So all the other CEOs are looking at this and...
I question whether that is really AI disruption. Dorsey is really good at building companies that have a lot of bloat in them. In 2019, there were 4,000 people with Block. By 2023, there were 13,000. A lot of that's the COVID ramp up. You don't need that many people. And remember...
Well, think about Twitter.
I was going to remember what company he also had started and was basically, Musk went in there and whaled other people to figure out how to drastically cut the headcount. I think Dorsey just remembered that, knows that he's got bloat, sees an off-ramp. I don't think it's so much about AI as it is he just had way too many people in a company that what he's good at is figuring out how to create a high margin enterprise and then therefore it could support way too much headcount, and he right-sized that.
I agree with his tactic though, because we're the benefactors of this. Is that him doing a rapid cut like that is when you think about the culture of the company, mm-hmm. It's way better to do it that way. We're on calls with some people that we're trying to recruit, where every Tuesday these companies in town let people go. Mm-hmm. Think about that type of culture, where you're scared for your job every Tuesday. Mm-hmm. You'd rather just get it done. So even though it's severe, I do think long term, his company's better for it from a morale standpoint, mm-hmm. not initially, but long term it is.
Yeah, so. And these, the CEO of Anthropic and OpenAI, previously, when people were worried about their jobs, they said, learn to code. Well, now AI can code really well, right? Human coding is becoming extinct. So now what they're saying is, go learn the trades, right? And it's hard to know how real that feedback is, given what they're seeing, the most advanced models internally, versus is that just marketing to recruit the best minds to their company?
Possibly, but I think it kind of gets back to what Brian was saying on that there are real people that are feeling the pinch. And I mean, this is not, once again, this is not different. Steinbeck made a living through writing about the farmers who were subsistence farmers as a mechanization of farming knocked out.
That was 40% of labor.
Right, and what happens because of that? Well, all of a sudden you need to be able to transport food because it's so abundant. So now you have new logistics, you have new trucking systems, you have refrigeration, you have all kinds of things that come out of it that over time, there's far more jobs that are created than were ever lost and are more meaningful, more impactful jobs. This time isn't different. It is the same thing. People are going through a rough time. Things are changing, but we can't think about it as tacticians. We need to be thinking about it as of strategy. And I think of our own industry, right? You get, we all know Jack Bogle, Vanguard funds, right? Index funds. It is a staple within our industry to use indexing on how you diversify portfolios. But whenever that came out, that's the end of the advisor. After that, you could make a phone call at a discount broker, and I think it was like $50 a trade, which was a big deal because it was 8% commission. And it's the end of the advisor. And then all of a sudden, there was a couple of people that was like, no more commissions, we'll do fee and lieu. Merrill Lynch got so mad that they sued, and but now everyone's on wrap. No one does commissions for the most part, to the point that the government is creating rules so you can only be fiduciary. I don't think that was the right approach either. And then I remember when iShares was a company in California, and they were calling me, we were using those ETFs before BlackRock ever purchased them. Well, this was the end of the advisor because all the 12B1 fees and all the other things that were going to go away. And then we had robo-advisors. And
now we have the direct indexing push where everyone's buying the S&P 500 for low. That wasn't seen as being possible.
And now we have AI in our industry, and owners are not. It's like if you're not moving up the value chain, then you are going to lose in your offerings. But we're already offering tax services, we're looking at estate services, we're trying to figure out how do you take all of this information to move up the value chain. We have less people in the investment committee, but far more families than we did because of the robo technology allowing us to trade in a much better way, right? So that's just moving up value chains. And I don't buy 1 minute that the software as a solution has come to an end.
Well, I think it's exposing what is the real role of an advisor.
Well, let's move to the software, because we've actually added software this year, added SaaS seats so far. So I know you've actually been the loudest that it's not ending. And we pulled our data. I was starting to think that we remove some things on the edges, and we pulled them. And it's hard to look at this and say, I want to get rid of, Holistoplan.
I do think that, it's interesting is that, we're looking at our annual technology spend, and I would say it's within reason. Usually a growing company like ours, you could easily spend 10% of revenue on, technology. That's normal in a fast-growing company, and we're doing that. And when you're looking at where we're allocating it, to Aaron's point, a lot of these technologies, it's not investment management. It's to actually care for families at a deeper level. It's the tax planning. It's the sales force to actually execute on a multi-purpose wealth planning aspect. It's not just one part.
Well, something that's interesting is every one of these technologies you could recreate with Claude Cowork, but the vast majority of these, we would never want to spend our time and energy doing that.
Well, the other thing that we're having though, and this is interesting, in the HR, so I'm over legal, HR, and finance is the areas. And I was recently talking to Tina, who's our new chief people person. We have 12 different softwares. So all of these are best-in-class softwares in the space. However, the amount of training, there's real, cost in training. There's costs in, trying to onboard someone to all of these things. So, it's going to be very interesting as these softwares come out because, the argument, and I agree with this side of the argument that software costs are going to decrease because the ease of entry is going to go in. But when you're sitting as a business owner, there's a cost of training also involved. So to go and move the ship from one software to another software, the amount of disruption and distraction that takes place is a real cost too.
But that's also assuming that those software companies still see their value proposition as it is today. They're not. One, these guys have lived in the world where they have to be competitive. They have to continue to up their game, more so than our sleepy industry of wealth management, yet we continue to move up the value chain. We figured out how we provide value, and it's going to be the same thing with Salesforce. Is they're just going to say, okay, well, now that we have all this data, which is really the oil going forward, how do we better utilize it? We're no longer going to be thinking of ourselves as we're facilitating this. We need to go a couple of levels up. Are there going to be software companies that get erased? Absolutely, there will be. There always is through this disruption. But they're going to figure out other ways of doing their pricing, of how they model. And as soon as one of it figures it out, the rest of them are going to go through, because this is, out of all the different industries that we cover, this is probably one of the most competitive. So they're used to always looking at our company.
And they're probably the earliest adopters using the new AI tools. Something I'm really excited about is we've had a dream of our own app, both for clients and internally, to integrate all of our data in one spot. And so I've spent the last couple of weekends while the kids are taking naps, I'm building the mock-up for these apps. And last year I was interviewing several software development, app development companies. What's the time? What would this take? What's the cost? It could be 1 to 2 years, $1 to $2 million to build an app of the caliber we're asking. And half of that cost and time was just in building the mock-up of what we want to go build. And just think about that ability, though, if companies like us can create new apps internally, new apps externally, that's not really deleting jobs. That's kind of raising the bar and excellence for clients, for internally, for your teammates. I'm excited about that future. And I think the potential is just so vast, and we're so early in this.
So Say's law says production creates its own demand. And so we're going to see that. As all of this proliferates and you can increase your value, more people become wealthy, and therefore the demand for other things go up, and all of a sudden we have jobs that we could not imagine. Could you imagine going back to your great-grandparents and saying, hey, well, there's going to be in the future a thing where somebody just takes videos of themselves for 10 to 15 seconds and they're going to make millions of dollars a year?
But so with that though, Aaron, I think that's interesting. So this displacement's happening. We're seeing that happen. And there's clear winners and losers here. And, I was talking to someone the other day, and, they were nervous about AI taking over our space. And one of the things I mentioned was in our accounting team, they were like, oh, well, AI is going to take care of it. My answer was, I hope so. There's a shortage of labor here. We can't find enough people to do the work. And this is just me as a business owner and looking at the accounting space. You travel across the country and you talk to hospital executives, there's not enough people going into healthcare. So what's going to be the catalyst that, you're looking at college enrollment and where people are studying. I looked at, AI, ChatGPT helped me do the research, so who knows if it's true or not, but, liberal arts got hit the hardest. No one's going into it. Education, there's not enough people going to education. So what's going to be social work, therapy? There's some experiences there. Those three are very important to the country. So what's going to be the catalyst of people actually going into those spaces, because there's such a huge amount of demand there, but no supply?
Well, Brian, and I think about Gatewood and what has already happened. So there's a new technology we had. So far, we haven't cut our tech stack at all. It has expanded in the age of AI, but there's a new technology on here called JumpAI. And it's an incredible meeting companion for advisors, and it has transformed the role of an entry-level advisor. At our firm, that's called Wealth Coordinator. And wealth coordinators used to have to put together a brief of the relational context. During the meeting, they'd have to write the case note and be typing furiously during the meeting. Then afterwards, they'd have to do the meeting summary and get the task synced to CRM, and there was all this follow-up. Well, we compressed all that time with this tool, and what has it allowed? Wealth coordinators to do higher value things, create nicer deliverables, maybe work on presenting in pieces of meetings. We still have wealth coordinators. It's just a way better job than what it was 2 years ago. And then there's also the aspect of just what it allows us to do as a firm. So John Gatewood, our founder, our director of advisor development, our dad, he's writing a book called The Listening Advisor. And we built a 25-point scorecard to where we can score the performance of advisors in every meeting for really how excellent was that meeting objectively. And we can coach them to improve their scores. That's translating into better advisors, better training programs. We know what to train to and what to coach to now, and ultimately a way better client experience. And that's what has me so excited, is just the real applications already happening, and we're just in the first couple innings.
I think that we're going to probably be increasing our technology spend in the next 5 years. And I'm excited for that. And I think the goal isn't that we're trying to replace, labor with technology. I think that we're experiencing labor shortage. We have a population birth rate that's decreasing here in the U.S. It's harder to get visas, so we have a workforce problem. And, one way to solve it is with technology. And I think that's going to be the card that Gatewood's going to continue to invest in, as well as continue to hire people. But I see our percentage of, spend on technology increasing over the next 5 years.
And Chris, I'm curious the connection then between software and all this change and private credit, and just hopefully we get into private equity.
What Brian was saying, my view, and I don't think you meant this, you said clear winners and losers. I think it's really unclear winner. There will be winners and losers. Mm-hmm. Trying to predict them is so hard because you get these new headlines of, well, Claude can do this, and that was 10 private businesses trying to do exactly what Claude just launched, and I think that's what.
Well, I think that with all the AI too is that I think what we're also going to be seeing is there's going to be heightened risk around cybersecurity and governance around AI, because we really don't know what the 10-year effect of governance is going to be. I mean, think of the amount of hacking that can take place and the amount of information. Remember when last year, I forgot what day it was, Amazon Web Services went down. Do you know how many businesses were impacted that day? Crazy. So the dependency on a software and the trickle-down effect and the ramifications of a business is not understood at this point.
I like the Amazon example for almost 10 years ago, where every time Amazon would announce a new service line, that whole subsector would just get killed, down 10% in a day. And that's what's happening with Claude. Every day you hear a new Claude, and then that industry gets hit. And so when you say what is going to happen to markets because of this, I think that the view we're saying is you're going to see losers, don't know what they are. We're diversified investors. We're not big software investors. You're going to see other winners that help cover those losses. So when you go to the private markets, that just describes the power law of some huge winners that win from AI and some big losers. Well, they're okay with their losses as long as their winners are covering them.
The funny thing, and he was bringing it up in what you're saying, is I was in a presentation of a guy that builds a lot of these AI platforms, and it was for a bank. And they had standard operating procedures, of which a lot of it had to do, you had to submit this form. And instead of changing the standard operating procedures, which would take time, they just trained the bot to create a form, make it into a PDF, to submit and go through the old process. And it's like, you think that, but why not whenever you're doing this? So who are the winners and losers? It's like, well, Adobe didn't lose on that, oddly. They should have, but because the change is happening so fast, and that's typically what you see is old technology that you think would replace gets reconverted and reused, and it becomes a new transmission line of the new technology, and it actually becomes even more important because of its new use case and its old. So
We're still sending emails to each other all day.
And
right?
I wouldn't be surprised, because there's so much compliance oversight on emails, and there's going to be a need for governance of these agents, if email becomes a system of how you oversee the agents, because there's so much infrastructure built on compliance and reading of emails. You'll just use that as your governing system. Maybe that happens, maybe it doesn't. It's just a hypothetical of how these things can play out.
One thing I would love, not for this topic, for this insight, but around parenting around it. I mean, I know in our initial discussion before we were airing is that the use of AI, I have 4 young kids, and the education system, there's a lot going on in that world, around the education around it and the impact on kids, on, where the kids are going to evolve if they don't have, certain habits or certain skills built in the next 10, 15
Well, think
years.
about it. If you hit the convenience button every time, what are you destroying? It's your ability to be resilient and tough. And that might be the core skill needed for kids in the next couple decades.
Well, and we saw it whenever the calculator came out, the scientific calculator. They just made the problems more difficult. And there are certainly things that kids are doing to make their work easier, and they're not becoming resilient. But there are also school models that have already figured a lot of this out. Alpha is one of them that's using AI, where they can take just the normal distribution kids, and within a couple of years, they're scoring in the 1% on the achievement test, because the AI can find out what's the gap in their education, and it closes it so quickly. So it's not that these kids are the geniuses, it's that this AI system can find the gap, and education is always something that builds off of itself.
So,
Are you trying to invite yourself back next month?
well, so this is just a little interesting topic. So majority of the families that I'm very fortunate. Like they're in the above $20 million of investable assets. It's very interesting watching them, because what we see, you'll have an entrepreneur that has done extremely well. They built a business. They've been able to create a lot of wealth. And some of them have been able to teach their kids how to work hard, discipline, sacrifice. They spent a lot of time teaching the kids. And the chance of having success, and now that the kids are adults and I know them very closely, they've been able to do much better than their parents, which is amazing. And there's other families that removed all the barriers for the kids. The kids went to the best schools. It's not education. But they don't have, Dan, to your point, the creative thinking, the grit, the ability to manage conflict. They were never taught, a lot of the lessons. And that's what I'm saying about with the AI is, it's an amazing tool. I mean, we use it every day. My family uses it every day. But, it's going to be interesting around the parenting aspect and how to actually make the kids productive, in the next 20 years.
I actually think that that's our big value play going forward with all the AI coming in, is in the wealth management world, especially I believe we will have more billionaires, not just because of inflation, but because of the excess productivity. And as we know, working with the higher end of society, the biggest anxiety is, how do you steward this wealth with the next generation? How do you take this Ferrari and hand the keys over to the 18-year-old type of component? So the family governance, I think, is going to be a major part of wealth management, because it is difficult to manage wealth. And if you didn't grow it, you don't have the necessary skills. It has to be an educational process. And I think that is something that our industry is poised to actually provide. We know what has worked with other families. We've seen this, and we can take those best practices and do that through a process where we're able to help generations continue to steward the wealth well.
Well, our industry has been fun because we've had, when I joined 10 plus years ago, it was the threat of robo-advisor. So we've been under pressure. That's all I've really known, is that threat is out there. But really think about when families going through something very difficult, or the market's down, and that panic feeling in your gut comes up, a robot's not going to keep you invested or help counsel you or give you wisdom or share an experience they've had that's really relevant, that helps you. That's a human being. That's a deep relationship. And I think the AI is going to take a lot of the technical work off our plate, and it's going to enable us to have deeper and more meaningful relationships with the families we serve. And that's how we're going to harness it, and I think how we're going to win.
Oh yeah, I mean, family dynamic. They call it family dynamics for a reason. Every family has their own dynamics, and there's a lot of shared dynamics among a lot of families, but people don't talk about it. So that's where, I think that deep knowledge on how to handle relationships is going to be a skill set that maybe AI can replace at some point. But at this point, I think humans are going to be the best way to actually relate to humans when it comes to the circumstances that you just mentioned, Dan.
I love the analogy, as we've had vending machines for over 100 years. If you walk into a bar, you expect a person to be your bartender. So.
Yeah, and I don't know about you guys, but it's like the more AI takes off, the more I crave, like, what's the phrase, touching grass? Like, you want to sit across from somebody in person. You don't want to be in the Zoom meeting. Like, you want to shake hands. You want to break bread with people. Like, the craving for that is just, it's rising, which hopefully all this AI just takes the parts that truly weren't most human about us away, and we do more of what makes us truly human.
If you enjoyed having all four of us here, I know I did, and I'd like to see more of it. If you would like to see Brian and Dan joining and other people from the team, hit that like button. And while you're down there, make sure you share it with our friends and also subscribe. And don't forget that we're also on Spotify. We love having you here. We want to continue to make some changes. We actually have mics coming to lose the screen, to come away from the news. I know everyone's tired of it, and more conversations. So please give us feedback if you enjoyed this format.
All right, well, let's leave it there.
We're
over time. Hopefully, maybe we'll revisit some of the AI stuff, the fun topics, and hopefully we move on from Iran next month. See you then.